In the previous video, we stopped here and I asked you to complete this, or maybe I didn't, but anyway, so you got the answers here. Pause it, work this on your own without looking at the answers. I'll just do this. I don't, in between recording these videos, I felt like if you had the answers and you had the information, you could redo it. So take a moment, see if you can't do 1 through 14. These are I believe these are the same from the beginning of the video, of the prior video. These are the same answers. You might even want to just do this. Why don't you do that? Why don't you just do the whole thing? Is it assets, expenses, revenues, and then what's the normal balance? And to review from the previous video, normal balance means that is how the account is increased. So some accounts will increase with a debit, some accounts will increase with a credit. ADE, AD clear, or AD clear, or AD clear, however you want to say it. It's a little memory tool. You could do this. You're taking the test, you know, it's okay. You can have a pencil, write down AD clear, right? When you start, you know, back when we took paper tests, I'd say sign your name and then write down AD clear. All good. I'm happy. Do it. It's a memory tool. You're saying, was that cheating? That's like a note. No, it was in your head already before you took the test. It's fine. All right, so you're just putting, it was in here, in your brain. It's fine. You're just putting it on a sheet of paper. That'll be great. ADE, these three are increased with a debit. The normal balance for all assets, dividends, and all expenses is a debit. That means we debit those accounts to increase the balance. CLR, contributions to equity, liabilities, and revenue are increased with a credit. All right, that's the normal balance for all equity, liabilities, and revenue. Okay, now the opposite is true. So assets, the balance for an asset account is the opposite of the normal. I'm sorry, I think I said that backwards. To decrease an ADE, an asset, dividend, and an expense account, to decrease that, you do the opposite of the normal balance. So you would credit those. And the same thing for like equity, liabilities, and revenues. You want to decrease them, you debit them. You do the opposite of what makes them go up. Makes sense? Take some practice. So make sure you pause the video. Please pause the video. Make sure you got these filled out, and then compare your work. Don't cheat. Please don't cheat. All right. So again, we mentioned this in video 1. We're going to mention it again probably a bunch of times. The accounting equation formula is assets equal liabilities plus equity. A equals L plus E. All right. And that means they're equal to each other. The total of the assets equal the total of the liabilities plus equity. Always must. No exceptions, okay? How you want to record some things. We give you some choices depending on the industry perhaps, but not so much this. That's accounting. So we want to make sure that at all times this is in balance. We want to make sure that our assets equal the total of our liabilities plus equity. Always. Now I want to just dig into equity real fast. What makes equity go up and what makes it go down? Contributions make it go up. Revenue obviously makes equity go up. Dividends and expenses make equity decrease. So dire. All right, that's another way to remember it if you like remembering things like that. So you have AD clear and you have dire now. So it could help you as you start to learn this. So when you're working with something up front, a new topic up front, there's a lot of memorization and you're just not relating to the material as well as you will after you've been absorbed in the subject matter for a longer period of time. So later on, you won't need dire and you won't need AD clear. And if I didn't teach principles, I might forget it myself, okay, to make my point. So those are good teaching topics that'll be useful to you for the next little while. So make sure you use those, or not teaching topics, mnemonics that could help you master the material faster. I'm going to skip number 2. Please look at example 2. Please read it. It shows you the accounting equation. I'm going to example 3. Record journal entries for March, the first month of operations, and then complete the financial statements using the following information. So we're fixing to get right into it here in chapter 2, okay? So there's a note here, very important. When what's computerized accounting now, and things just bam, they just show up. Everything's done. We just push a button and the system updates to what we're fixing to talk about. But when it was manual, and it will be manual for you because you'll be doing this manually and working problems, the order preparation is essential. The computer's doing it in this order, by the way. It just happens so fast you don't realize it. So net income is first, then retained earnings, and then the balance sheet, okay? 1, 2, 3, in that order. No exceptions, okay? Don't fight it. And if you're a Star Trek fan, just pretend you're being assimilated by the board. You have no choice here, okay? So net income, statement of retained earnings, and the balance sheet. No choices. It won't work any other way, all right? And if you show me an exception, it's just going to be a one-off, okay? In a million years, it's just the way the problem's set up. So just do it this way, and you won't have to worry about getting the right answer. It should just fall right into place, okay? So net income, retained earnings, and then balance sheet. So anyway, so we have a fictitious set of transactions that we're not given the reasons for. But this is where I like to remind you that a good way to learn journal entries as you begin to do these more and more in this course is something I like to call Jeopardy. We give you the journal entry, just like in the game show, they give you the answer and then you have to come up with a question. So in this case, we're given the journal entry, merchandise inventory, and then accounts payable. You can abbreviate it AP if you want. So that's the answer. What was the question? Or what was the transaction? Well, they bought inventory, merchandise inventory. This company bought merchandise inventory and did not pay for it. They bought it on account. They said, well, we'll pay in a few weeks. Bought inventory and said we pay it in a few weeks for accounts payable. Pretty cool, huh? On the 18th, it says a debit to cash. Remember, that's the normal balance for an asset, cash. As a side note, just think through this as I say this. Of all the accounts and all of accounting, which one do you think is the busiest? Which one do you think has the most hits, most recordings? Cash. Or it should be, most companies. All right, so of course, then again, I came from a lender, so maybe it's different for other companies, but it sure doesn't seem like I've ever seen any company I've ever worked with that cash wasn't the main account as far as activity goes. Anyway, so they debit cash means they got cash, okay, because normal balance for an asset's an increase, and it's a debit, so it's an increase, so they got cash. Revenue is normal balance for revenue is a credit, so they're recording revenue, they're an increase in revenue. So evidently, whatever this company does to generate revenue, they were paid for it. Pretty cool, huh? You're looking at this journal entry and really getting a lot of information about what happened in the company. Cost of goods sold, merchandise inventory. Cost of goods sold does not have this word. It is not an expense. That's why it's not there. However, even though I'm telling you not to think of it as an expense by showing you that I wrote it and then I delete it, it's okay to think of it as an expense. The company made inventory. Let's say it's Ford, and they sold, and goodness, I hope the Ford F-150s cost Ford more than $5,500 to make, but they're making a lot of money off of them, aren't they? If it is, what are they selling for? 60, 70,000 new now? 80? Anyway, so I hope the Ford Festivas cost Ford more than $5,500, but whatever. Let's say whatever they're selling is $5,500. Cost them $5,500 to make, and they sold it to the dealership, and the dealership's now trying to sell the car to the public. So they debit the cost of goods sold. That's putting that expense on the income statement, and merchandise inventory is an asset, and the only way to remove an asset with a normal assets have normal balance of debits. The only way to remove an asset from the balance sheet, the only way to lower the balance on an asset, the only way to decrease the balance on an asset account is to credit it. Cash is an asset account. We debited it, so I made it go up. Inventory is an asset account, and we credited it because we were trying to lower the balance. So we sold a car. It's no longer at the plant. It's off at a dealership somewhere in America or Canada or Mexico, wherever. Okay. So let's put an income statement together. There's two things you got to remember. Revenue minus expenses equals net income. So let's go through this. The only revenue we had was right here. Right there. All right. And there it goes. 15,000. All right. So our expenses, cost of goods sold, is, I told you, treat it like an expense. Later on one day, I can't remember if we get to it in this course or not, but if we don't, you just need to know before you get there, just hit me up and I'll explain it to you why it's not truly an expense. But cost of goods sold is treated as an expense. Selling expense, administrative expense, total expenses. All right, I don't think we had all those in this fictitious example. So we just put all our expenses here. They add up to be 10,000. 15,000 minus 10,000 gives us a net income of $5,000. We need that net income to do the equity statement. Now this company just started, so on March 1st it was zero balance because they did not exist prior to March 1st. So this is the only month that's ever been in existence. Net income increases retained earnings. They paid out dividends. Remember Dyer? That's how we know what goes up, what goes down. So revenue and expenses is part of Dyer, RE. It's here, right there. It's the net of revenue and expenses. There's no contributions, but they did have D and Dyer. No investment, no contributions for the I, but they did have D, dividends they paid out. That's a deduction. So 0 plus the difference between revenue and expenses or net income plus minus 2,000 means they have retained earnings at the end of their first month in March, which is March, $3,000. Again, this is all fictitious. We're just going over how the numbers would roll. Cash, accounts receivable, supplies, all of this adds up to be $6,100. Now don't forget that we have assets equal liabilities plus equity. All right, so this is $6,100 for assets. That means this total right here must equal $6,100. And we know it does, but let's just walk through it. Accounts payable is 100, that's a liability. Common stock is 3,000. Retained earnings is 3,000. This is equity. That's equity. That's liability. So liability plus 6,000, 100 plus 6,000 is 6,100. They do balance. Okay? Well, that concludes this video. We knocked out chapter 2, part 1 out in 2 videos. If you have any questions, please email me.